So, opportunities to come and go. And one of the things that certainly moved the market this past week was the FOMC meeting. What does that mean? The Federal Open Market Committee. And this is when the Federal Reserve gets together and they have their meeting. And then afterwards, the chairman, Jerome Powell, goes out and talks about what they talked about and takes questions. And it's really been interesting.
It certainly was. A lot of folks were focused on it. The outcome of the meeting really wasn't that surprising in the sense that they kept interest rates unchanged. But what did surprise some people, at least in terms of the communique, was that the Fed is moving faster than expected towards normalization. And by that, I mean each member of the FOMC has what they call dot plots. And those are their forecasts of where they believe short-term interest rates will be in the coming months and years. And those dot plots move forward. In other words, they believe interest rates will rise a little sooner than they had previously. Now, after the FOMC meeting, Powell did do a press conference, and he elaborated a lot on that and suggested that while they're nowhere near raising interest rates, they certainly are vigilant on what's going on with inflation. They talked about transitory effects, as we have on this program any number of times, and he cautioned people not to overreact to that. So it was a fairly dovish interpretation of the dot plots. But that, of course, was set all upside down on Friday morning. I expected a really quiet, Friday market. But no, St. Louis President Bullard came on, who's a non-voter. So he did not vote on the FOMC. But he basically was much more hawkish than Powell was and talked about how inflation is greater than they expected. So it was tilted much more hawkishly than what Powell had done.
Yeah, that's right. So 13 of the 18 governors did say that interest rates may go up in late 2023 versus 2024. But I guess I'm agreeing with you, Derek, is that there's been some overreaction. Think about it. We are in June of 2021. We're talking about raising interest rates 2 or 3 years down the road, and the market reacted, and it certainly did on Friday, down significantly. At one point, Derek, it traded at 33,333.33. So if you believe in the Trinity, there was a whole lot of threes on the table. Another thing I do want to talk about is this zero interest rate policy continues, and that is good for equities.
It should be, because real interest rates are negative. So if real interest rates are negative, you're going to look elsewhere to generate a real return. Dividend-paying stocks would be one suggestion, for example. The other thing that happened this week was Jeremy Siegel, who was actually my advisor at Wharton Business School, was on talking about all the liquidity in the system. And the thing is, a lot of this liquidity has yet to hit it, right? We had a bill passed in December. A lot of that money still hasn't been spent. We're talking about another infrastructure package. We're talking about, unemployment benefits, household net worth at record highs. So there's a lot of liquidity in the system. And ultimately, that usually is inflationary, particularly if you have manufacturing bottlenecks and the inability to hire workers at prior wages.
So he indeed did talk about, and I saw that as well, that excess reserves is going to be inflationary. The question is, how long is it going to take to work its way through? Is it 2 years, 5 years, or 10 years? And that's what we don't know. But there's certainly something to pay attention to, as the GDP report, again, is telling us 7%. I mean, if we'd have talked about that over the last decade, you thought we were drinking before we did the show. And I'll tell you what, 7% GDP is a big number.
It certainly is. It's one of the biggest numbers we've seen in my entire career. And it is probably a peak number, because we're going against an economy last year that was basically closed. So the comparison is very easy, just as the comparisons on inflation are very easy. So all of this is uncharted waters. This requires discipline, a process that's thoughtful and methodical, and one where you take advantage of volatility where it presents itself, particularly as asset classes move in divergent directions.
So I just wanted to do a quick review. They talking about tapering, so we'll have to see if they continue buying these mortgage-backed securities. Zero interest rate policy is with us. GDP is good. Inflation, according to the Fed, is transitory. All of this means it should be good for equities in the near term.